In 1970, a single income, one paycheck, no spouse required to work, was enough to buy a home, raise a couple of kids, and retire with a pension. Today, plenty of households have two full-time incomes, no pension in sight, and still feel like they're one bad month away from trouble. Nobody got lazier in 50 years. Nobody suddenly forgot how to budget. The floor moved. And once you see the actual numbers behind that shift, it stops looking like a mystery and starts looking like simple arithmetic. Let's start with the size of the middle class itself, because it's not just a feeling, it's measurable. In 1971, 61% of American adults lived in middle-class households. By 2023, that had fallen to 51%. Over that same stretch, the share of the country's total household income actually held by the middle class collapsed even harder, from 62% in 1970 down to around 42% by the early 2020s. Meanwhile, the upper income tier's share of total income nearly doubled. The middle class isn't just smaller as a group of people. It's holding a dramatically smaller slice of the country's total earnings than it used to. Wait, so middle-class people aren't just staying still, they're actually losing ground relative to everyone else? Losing ground relative to the top, yes. Median middle-class income has still grown in raw dollar terms since 1970. The problem is what's happened to the cost of everything that income has to cover. Start with housing, because it's the single biggest line item in most family budgets. And it's also where the math has shifted the most dramatically. Back in 1970, the typical new home cost around 3.2 times the median household income. That's a ratio most families could actually work with. By 2022, that ratio had climbed as high as 5.8 times income, nearly double what it was 50 years earlier. Even accounting for swings in mortgage rates, which genuinely do matter, a lower rate today doesn't erase a home price that's grown twice as fast as paychecks have. My parents bought their first house in their 20s on one salary. I make more than my dad ever did, and I still can't afford what he bought. That's not really a contradiction. It's the price-to-income ratio, doing exactly what ratio does when the top number grows faster than the bottom one. Zoom into an actual city, and the gap gets even starker. In the Boston metro area, the average home cost about $19,600 in 1970. By 2022, that same average home cost roughly $685,000. Median income over that same stretch went from around $9,000 a year to just over $106,000. Do the division on both ends, and buying power for an ordinary family in that market fell by close to 2/3. That's not a uniquely coastal problem either. It's just more extreme there. Similar math, at a smaller scale, has played out in most major metro areas across the country. Now let's talk about pay itself, because this is where the story gets more debated, and it's worth being upfront about that. According to the Economic Policy Institute, since 1979 productivity, essentially how much economic output each hour of work produces, has grown by roughly 90%, while typical hourly worker pay over that same period grew by only around 33%. In plain terms, the economy as a whole has been producing significantly more value per hour worked, but a much smaller share of that extra value has been showing up in typical paychecks. Where did the rest of it go, then? Depending who you ask, into corporate profits, into pay for the highest earners, into shareholder returns, or into rising benefit costs that never show up in a wage number at all. Some economists push back hard on exactly how this gap should be measured, arguing that once you account for growing non-wage benefits like health insurance and adjust for how you measure inflation, the true gap looks considerably smaller than the headline number suggests. Reasonable, credentialed economists genuinely disagree on the precise size of it. Almost nobody disagrees that some real gap opened up starting around that period, even if they can't agree on exactly how wide it is. On top of that pay picture, sit the specific categories of spending that have outpaced inflation itself for decades. Healthcare, childcare, and college tuition, the exact expenses a middle-class family can't simply opt out of. Take employer health insurance. In 2000, the average inflation-adjusted premium for family coverage was just under $12,000 a year, split between what the employer paid and what the employee contributed. By 2023, that same average family premium had climbed to nearly $24,000 a year, doubling in real, inflation-adjusted terms in about 2 decades. And employers haven't just been passing along a flat increase. they've been shifting a bigger share of that cost onto workers directly. Back in 2000, employees covered roughly a quarter of their family premium. By 2023, that had grown to closer to 30%. The bill got bigger, and more of it got mailed to the employee. I thought getting health insurance through my job was supposed to be the safe, stable option. It still beats not having coverage at all. But stable and getting dramatically more expensive every single year have somehow become the same thing. Childcare tells a similarly steep story. Between 1990 and 2015 alone, childcare costs grew by roughly 175%, more than double the pace of general inflation over that same period. Some analyses looking at the full stretch since 1990 put the increase at over triple the original cost, once you account for the years since. For a lot of families with young kids, that means childcare now competes directly with the mortgage or the rent as one of the 2 or 3 largest line items in the entire household budget, in a way it simply didn't for their own parents' generation. College tuition has followed the same trajectory, and part of the broader pattern here has a fairly boring, non-conspiratorial explanation economists call Baumol's cost disease. It still takes roughly 1 teacher to teach 1 classroom, and 1 nurse to care for a set number of patients, the same way it did 60 years ago. Those jobs never got a manufacturing-style productivity boost the way, say, building a car did. But the wages in those fields still have to rise over time to keep pace with what people could earn in other industries, or nobody would choose to become a teacher or a nurse at all. The result is that labor-intensive essentials, the stuff you genuinely can avoid needing, have simply gotten structurally more expensive relative to income, year after year, almost regardless of who's in charge. Layer all of that on top of a second major shift. What actually happens when something goes wrong? 50 years ago, a much larger share of American workers had a traditional pension, a guaranteed monthly payment for life, funded and managed by their employer, with the employer bearing the investment risk. Today, that's largely been replaced by 401k accounts, which shift both the responsibility for saving enough and the risk of a bad market year directly onto the individual worker. So if the market crashes the year before I retire, that's just my problem now? Pretty much, yes. 50 years ago, that risk sat with a company's pension fund and its actuaries. Now it sits with whoever happens to be logged into their retirement account. Union membership tells a similar story. Unions historically gave workers real negotiating leverage over wages, benefits, and job security, functioning almost like a built-in insurance policy against exactly the kind of wage stagnation we just walked through. Union membership in the private sector has fallen from roughly a third of the workforce in the 1950s to a small fraction of that today. None of these changes show up as a single dramatic headline the way a stock market crash does. They show up quietly, one household at a time, as a slow transfer of financial risk from large institutions onto individual families who are on average far less equipped to absorb it. Put all of this together, and you get something economists sometimes call the 2-income trap. A generation or 2 ago, a typical middle-class family could get by on 1 income and treated the second income, if there was one, as a cushion for extras, vacations, savings, a bit of breathing room. Today, that same family frequently needs both incomes just to cover the fixed, non-negotiable basics: the mortgage or rent, healthcare premiums, and childcare. So doesn't second income just mean the family has more money? On paper, sure. But if that second paycheck is already fully spoken for by childcare and a bigger mortgage before it even hits the account, it was never actually extra money. It was the price of admission to a 2-income lifestyle that a 1-income family from 1975 never had to pay in the first place. That arrangement looks stable right up until it isn't. 1 layoff, 1 medical emergency, 1 job loss in a 2-income household doesn't just cut the family's income in half anymore. It can wipe out the entire margin that used to exist specifically to absorb a bad year, because that margin, the whole point of a second income historically, has already been fully committed to fixed costs before the emergency even happens. So who's actually responsible for all of this? It would be satisfying to point at 1 villain, 1 policy, 1 industry, and call it a day. The honest answer is Messier. So it's not corporate greed, then? It's rarely ever just one thing. And anyone selling you a single, simple villain is usually leaving something important out. Some of this is a story about corporate power and the erosion of worker bargaining leverage. Some of it is a story about globalization and automation genuinely changing which jobs are worth what in a global labor market. Some of it is a story about interest rates and housing policy inflating asset prices faster than wages could ever realistically keep up. And some of it, the college and healthcare and childcare piece specifically, is a structural feature of any economy where certain essential jobs simply can't be made more efficient the way manufacturing a product can. Economists actively argue about how much weight to put on each of those causes, which policy choices mattered most, and which ones were simply inevitable. And that argument isn't settled, and probably won't be anytime soon. What is settled is the practical result sitting in most middle-class households' budgets right now. The income is genuinely higher than it was 50 years ago in raw dollars. But the price of the handful of things that actually define a stable middle-class life, a home, healthcare, education for your kids, has grown even faster, and the safety net that used to exist underneath all of it, the pension, the union contract, the single income that was actually enough, has largely been quietly removed. None of that means the situation is hopeless, or that individual choices don't matter anymore. It does mean the goalposts genuinely moved in a measurable, documented way, and comparing your progress to your parents' generation using their old rulebook was never going to produce an honest comparison. You're not imagining that it's harder. You're just finally seeing the actual math that's been quietly running in the background the whole time. If you want the full breakdown on the two-income trap specifically and how families are adapting to it today, let me know in the comments and I'll build that one next.